Hi there, welcome to GTP TV. My name is Richardson, and today I'm going to talk about borrowing in a self-managed super fund. Borrowing in a self-managed super fund has come to light more recently. Those of us that read either the financial press or even the financial papers on the weekend in the common newspapers like the Herald Sun and the Age, quite often they're talking about borrowing in a self-managed fund. Now, for me to give you an idea of how it works, I need to give you a bit of history. Borrowing has really never been allowed in the self-managed super fund. There's a whole section devoted in the legislation for superannuation which states that a self-managed super fund isn't allowed to borrow. Now, this was all changed because of Telstra shares. About 14 years ago, Telstra shares came on offer to the Australian public, and it was released in 3 different stages. Now, each of those releases, you'll note that the Telstra shares were actually offered in 2 instalments. So, for example, in the first offering, the Telstra shares were $3.30 and you had to pay $1.95 up front. The remaining $1.35 didn't have to be paid for 12 months. And the issue with this, based on the superannuation legislation, was that actually was deemed to be a loan. And that arrangement by itself actually contravened the superannuation legislation for all self-managed super funds that held Telstra shares. So the legislation was amended to allow that type of structure, which was called an instalment warrant. It allowed that type of structure to be in place for a self-managed super fund. Now, the unintended consequence of that was that superannuation funds could now use this same structure to buy property, not just shares. So that's the history of it. It sounds simple, but it's not that simple. And one thing to keep in mind is that if you're going to borrow in a superannuation fund, there's lots of things you have to take into account. It's not like mum and dad going to buy a rental property outside of a super fund, which is normally pretty easy to follow. This has got a lot more rules. And I've got the rules up here on the board. These are the 4 main ones. There's others that are in the actual legislation, but these are the ones that really have to be taken note of. So the first one is, if you're going to borrow in a self-managed super fund, you can only borrow to buy one single asset. So in other words, you can't borrow to buy a portfolio of shares, and you can't use one borrowing to buy one property here and one property there. Each borrowing arrangement must be under a separate instalment warrant. The second one is, you can't borrow to improve an asset that you purchase. So for example, if you wanted to buy Renovator's Delight as a property and demolish it or add new rooms or completely renovate it, that would not be allowed under the legislation. Also, if you demolished a property, that wouldn't be allowed, and rebuilt, that would not be allowed as well. So it's something you have to be very careful about. You can borrow to pay for associated costs such as stamp duty and other charges, but you can't borrow to improve a property. The third one is, the asset cannot be owned initially by the super fund. If you're borrowing to invest, it must actually be owned by a separate bear trust. Now, this has to be quite carefully established, because the bear trust basically means that its only purpose is to hold an asset. It has no other purpose. It doesn't lodge any income tax returns. It doesn't do anything else other than own the asset that's going to be effectively owned by the superannuation fund. But that is one of the rules. The fourth asset is, the borrowings that you do receive to help fund the purchase of the asset must be under what's called a limited recourse arrangement. And what that means is, in the event of default of that loan, the lender, which is up here, okay, they can only attack this asset. So they can only sell that asset to get their money back. They cannot have any access to any other assets of the self-managed super fund. So we'll find, when we talk a bit later, we'll find why that actually has a big effect on how banks view this type of transaction. Now, just a little bit more about the bear trust. The bear trust basically is a new trust that will operate. It needs to have a company as trustee. Now, the company that's trustee of the bear trust cannot also be the company which is the trustee of the self-managed super fund. And also, it would not make sense for that company to either be a trading company in its own right or be an investment company. So our recommendation is that any company that you do set up as a trustee of this bear trust must be a new company. But again, remembering the bear trust's only duty is to hold that asset. If and when this loan is completely paid out and the mortgage released by the lender, then title of that asset can transfer to the self-managed super fund, and this basically disappears. Okay? Now, providing the bear trust is set up correctly for a start, there'll be no stamp duty on that transfer. But again, it's very important to get that trust set up for a start, because if it's not considered to be a bear trust, for example, it has other capacities other than only holding an asset for the benefit of the super fund, it may be considered to be a transfer and full stamp duty is payable. Other consequences of this arrangement. Now, the first thing you have to keep in mind is if you want to borrow in a super fund, there's going to be some significant costs. When you look at establishing the Bear Trust, establishing the corporate trustee of that Bear Trust, and also the bank's approach to this type of lending is because of the entities involved. We've got two entities here, which is trustee and Bear Trust. Here we've got two entities as well, which will be trustee and self-managed super fund. Their approach is they have to do a lot of legal work to make sure the arrangement's done correctly. Also, if there's a lender that's not a bank lender, other agreements have to be put in place as far as putting together a limited recourse loan. So you'll find when you add those costs in establishment and the establishment costs and legal costs of the bank, you're looking at around up to $5,000 to set this up. So that may be prohibitive for a start, but that's something you can't get around at this stage, especially with the bank's approach to it, because it is a complex arrangement. The other thing to keep in mind is that banks have, because it's a limited recourse loan, banks have a different approach to standard property as to how much they might lend against that property. Sometimes they may not even lend for a type of property. The examples we give are for residential property. Banks generally are okay with this arrangement. Okay, they normally lend up to 70-75% of the value of the asset. However, when you get to commercial property, banks in most cases will lend, but they may only lend up to 60 or 65% of the value. Prime production land is actually a different matter altogether. We've had some banks that say they won't do it for rural land, which we find completely hard to follow, but that's just the landscape at the moment. But if you shop around, you probably can find a lending entity that will do that. But at the moment, banks have differing views on this because these types of arrangements are also new to the banks. Now, the biggest issues we find is that very much because of a lot of misinformation that does get in the financial press, a lot of clients and consumers think, oh, this is the way to go, it's so easy and it's just a ticket to make money. It's not. It's like any other lending arrangement. You have to make sure that what you're actually buying into is a decent investment. The other thing is you've still got to comply with the standard self-managed super fund rules. Okay, you must have an investment strategy which allows for this type of transaction. You also must ensure that if you're actually acquiring this property from a related party to the fund, that you're allowed to, because certain properties aren't allowed to be acquired from a related party. So, for example, residential property. There's lots of people with residential properties in their own names, but a self-managed super fund cannot acquire that from a member or a relative of a member. And the other thing to keep in mind, and this is the one that catches a lot of people before they enter these sorts of arrangements, is that this asset that you buy, any member of your family can't rent it, regardless of if they're paying market value or not. A related party, if it's residential property that is. If it's business property, there are concessions available for that arrangement to take place. But they're the things to keep in mind. Remember always that all borrowing does is it magnifies your return. It doesn't guarantee that you're going to make money. If it's negatively geared, the term negative gearing is shopped around as if it's some magical way of inventing money. It's not. It's a cost. Okay? Negative gearing means you're making a loss on the property for tax purposes and it reduces your taxable income. It still costs you even after you get that tax refund back. So just make sure that anything you're going into is a decent investment first. Borrowing will just magnify that return. If it's a bad investment, borrowing will make it an even worse one. So just keep that in mind. Now, the other things we are very adamant about that people must address is how you're going to fund repaying these loan payments. If it's going to be funded by other investment income from the self-managed super fund, that's normally a reasonably good position to be in because you're not relying on the performance of this asset to help pay that loan off. However, if you're relying on rental income from this asset to pay back that loan, you have to take into account a few things. What if, one, it's commercial property and you cannot get a tenant? Where's the income going to come from to pay that loan back? Also, you have to make sure that any rental budgets you've done are actually realistic. Okay, so are they based on what an agent tells you? Because in many cases an agent might overinflate the typical rent you could generate from that property in order to get you to buy the property in the first place. Have you taken into account commissions, ongoing costs, those sorts of things? Can your arrangement handle the fact you might not get a tenant for 2 or 3 months or for 9 months? What happens if they leave? What if they're in there and they don't pay rent? Okay, where's your income going to come from to actually make those loan repayments? So you need to make sure you've got that addressed. The other thing is if your loan repayments are coming from contributions that you're making on a regular basis, whether they're through salary sacrifice, whether they're through making tax deductions at the end of the year, whether they're through personal contributions you make that you aren't claiming as a tax deduction, can you continue to afford to put them in? What happens if you get injured? What happens if you lose your job? Where's that income going to come from to help cover these loan repayments? So on that basis, you need to think about things like income protection insurance. In the event you are injured or you're ill and you don't have the capacity to work and contribute, is your income going to be reliable every year to make those contributions? So there's just a lot to keep in mind. Again, just don't think, oh, it's a magic way of just owning a property at the end. There's a lot more to it. Now, I've told you lots of reasons why you shouldn't do this, but there are plenty of good reasons too, and they're the ones we can focus on now. One thing we do want to emphasise is that a self-managed super fund is still about the best asset protection vehicle you can find. It gives you protection from creditors unless you're making contributions, and the only reason you've made those contributions is to keep away from your creditors. But if you're doing that in advance, the amounts you've got in super are protected. The other thing to keep in mind is that any property that you do buy, make sure you've got adequate insurance and appropriate insurance on it for all sorts of risk. Because if you don't, the last thing you want is it burning to the ground and then you've basically got no asset. Other things to keep in mind is that if you're funding this via tax deductible contributions, it's actually a great way to pay off principal off your loan and effectively get a tax deduction for it. So either through salary sacrifice payments, through your employer, or through continued contributions that you're claiming a tax deduction in your own name for, and you're using those contributions to pay off the debt, you're effectively getting a tax deduction, which you cannot do outside of super. Any loan repayments you make on any investment property outside super must come out of tax, after-tax money. So that's a really important consideration. And probably one of the main things from a tax point of view where the advantage is that if this arrangement is positively geared, that means you're actually making income out of it after all costs, and there's taxable income. The maximum tax rate on any of that income in the super fund is 15%. Okay, when you compare that to the top individual rate of 46.5%, that's quite a saving. Secondly, in the event that asset is sold, and assuming you've held it for more than 12 months, the maximum tax rate you'll pay in the superannuation fund on that capital gain will be 10%. Now, the maximum in an individual's name is 23.25, so again, there's a big saving. Now, if you happen to be able to generate those transactions, either positive rental income or a capital gain, when you're withdrawing a pension out of your superannuation fund, the tax rate on those transactions changes to 0%. So again, that's the ideal scenario for us all. If we can use the tax system to help us pay that loan off, then we can generate income in our own names, in the super fund name, which is either a capital gain or rental income at 0%, well, you've basically achieved what you've tried to achieve by setting up this arrangement. The main thing is get advice, really do your homework, really plan your cash flows. Your cash flows is the most important thing out of all this. And come and see us.